The drop in the cost of capital helps small caps disproportionately. In contemporary India, as the cost of capital falls thanks to the enhanced flow of household savings into the financial system, smaller businesses benefit disproportionately relative to the large, highly reputed household names that dominate the stock market. There are two key reasons for this. First, the cost of capital in India is higher than that of the most other emerging markets. Exhibit 52: lending rates in India are structurally higher than those of peers. Secondly, for smaller businesses, the cost of capital is higher than the Indian norm, regardless of whether they borrow from banks or from the bond market. Exhibit 53: SMEs in India face higher borrowing costs from banks. The development of the corporate bond market is also likely to lower the cost of funding, especially for smaller companies. Historically, smaller companies had no choice but to borrow from banks. Now, as the bond market deepens, high quality smaller companies will increasingly be able to get cheaper credit from the bond market than from the banks. For example, a small company uh, such as La Opala seems to be borrowing money from banks at 9.65% per annum as per its FY16 annual report. Were the same company to borrow money from commercial paper market, it would be able to lower its cost of borrowings to around 7%. Investors need professional help in identifying high quality small caps. In general, small companies are riskier than the large ones. They are both fundamental as well as non fundamental reasons for the risk. On the fundamental side, smaller companies often stumble in trying to become big. Significant investments in systems and processes across functions such as human resources, information technology, data analytics, supply chain, manufacturing, and advertising are often not needed to run a small company. However, the lack of proactive investment in such systems and processes makes it harder for these firms to scale up without running into logistical or financial issues. We reproduce a quote from Captain Gopinath, founder of Air Deccan, which was eventually sold to Kingfisher Airlines in spite of being the pioneering low cost carrier in India. In his book Simply Fly 2012, Gopinath laments: given a little more time, Deccan could have weathered the storm and overcome the cash crunch, but time was running out. I might have pulled it off had my IT systems not collapsed. We had to bear in mind the welfare of 4,000 employees, the public insurance funds, and retail investors we had to answer to. These problems are inflated in India because often promoters are not willing to empower professionals in senior managerial roles. Instead, the promoters stuff the board of directors and senior ranks of management team with friends and family members. The lack of a high quality professional management team means that as and when the problems arise, as they inevitably do in most companies, many smaller companies often do not have the management bandwidth to deal with them. One such example is that of TTK Prestige between 1999 and 2003, when the firm went from a position of strength to brink of bankruptcy in just 4 years. See exhibit below. This downfall was due to a combination of labor issues in its manufacturing plant in Bangalore, a recessionary environment in India, stiff competition in its export market US, increase in excise duty on pressure cookers from 8% to 16%, and the failed launch of a new product leading to inventory write offs. Recollecting this troublesome period, K. Shankaran, director at TTK Prestige, said in May 2013: the biggest issue we faced was that although we had grown to a decent size, we were still running TTK Prestige as a small company. There was no segregation of responsibilities among senior managers, and hence every senior manager was working like a jack of all trades. We had to change that. Exhibit 54: TTK Prestige deteriorating financials from FY 2000 to FY 2003. Moreover, smaller firms often grow at a rapid rate, riding on the back of the success of a single product. When demand for their core product dips due to fads, fashion, or the economic cycle, the smaller firms find their revenues plunging far more sharply than bigger and more diversified businesses. For example, Eicher Motors almost stopped producing its famous Enfield bullet motorcycles as the firm went into deep financial distress, with the motorcycle division incurring losses in the year 2000. Enfield sales had dropped to 2,000 units a month against a manufacturing capacity of 6,000 a month. Though the bikes had die-hard fans, there were also frequent complaints of the engine seizures, snapping of the accelerator or clutch cables, electrical failures, and oil leaks. Many found them too heavy, difficult to maintain, with the lever inconveniently positioned and a daunting kickstart. It wasn't until there was an intergenerational change in the management when Siddharth Lal took charge of the motorcycle division in 2000 and of the entire firm in 2006, brought in Volvo as a JV partner in 2007, and diversified and professionalized the business that the firm began its glorious run. Over the last 10 years, that is FY 2007 to 2017, iShares profits and share price have compounded at 40%, 56% per annum, respectively. Whilst large companies have their share of major accounting issues, Satyam, Enron, WorldCom, Global Trust Bank, the list of prominent companies which cook their book is long. Such issues show up more often in smaller companies where a combination of fly by night auditors, unscrupulous promoters, and weak to non existing sell side research coverage create greater scope of accounting skullduggery. As per Ambit Capital's proprietary forensic accounting model, the probability of a company having significant accounting issues increases as the market cap of the company decreases. Exhibit 55. Larger capitalization firms have better accounting scores on average. As a result, whilst the scope of for generating superior long-term investment returns is significantly greater with small caps relative to large caps, the need for professional help is disproportionately greater than in case of the large caps. The good news is that the Indian fund management community now offers several high quality small cap and mid cap funds, both in the mutual fund format and in the PMS format. More specifically, while the BSE 100 has compounded at 16.7% per annum over the past 8 years, the BSE Small Cap Index has compounded at 21.4% per annum over the same period. Therefore, investing in small caps alongside such a fund manager can materially boost investors' long term returns. We shall return to this point in the final chapter of the book. The three key takeaways from this chapter. Number one, over the past 2 decades, small caps have outperformed large caps in most large stock markets. There are two key drivers of this outperformance. Smaller companies have the potential to grow their profits much faster than large companies. And secondly, as small companies grow in size, they are discovered by the stock market. That is to say, successful small caps gradually attract more research coverage from brokerage analysts and thereafter attract more interest from institutional investors with deep pockets. Number two, ever since the NDA led government launched its multi pronged attack on the black money in India 2015, affluent Indians have diverted savings away from the real estate and towards the financial system. This deepening of the financial markets is helping reduce the cost of capital in India, which in turn benefits small businesses disproportionately. Number three, whilst the scope of generating superior long term investment returns is greater with small caps, the need for professional help is disproportionately greater. This is because small companies are riskier than the large ones due to both fundamental as well as non fundamental reasons. The good news is that the Indian fund management community now offers several high quality small cap and mid cap funds. Chapter 6. How patience and quality intertwine. I've seen many storms in my life. Most storms have caught me by surprise, so I had to learn very quickly to look further and understand that I am not capable of controlling the weather, to exercise the art of patience, and to respect the fury of nature. Over the past 26 years, the BSE Sensex, a commonly used benchmark for stock market returns, has delivered compounded annual return of 13.7%. This return is 5.7 percentage points higher than the risk-free rate of around 8% prevalent during that period and 6 percent points higher than the consumer price index inflation of 7.6% per annum over the same period. By all accounts, the Sensex has given a satisfactory return over the past 26 years. Despite this, the common perception among the investors in India is that more often than not, people lose money in equity markets. What explains this investor pessimism with respect to equities, given that the asset has given healthy returns? The answer to this can be understood through Shlomo Benartzi and Richard Thaller's papers published in 1995, which termed it myopic loss aversion. They defined loss aversion as we regret losses 2 to 2.5 times more than similar sized gains. Let us assume we buy two stocks A and B for rupees 100 each and sell them for 95 and 110 respectively. We thus book a gain of rupees 5 in total, gain of rupees 10 on stock B minus the loss of rupees 5 on stock A. In this situation, applying the logic of Benartzi and Teller, we will regret the rupee 5 loss on stock A at least as significantly, if not more, as we would rejoice the gain of rupees 10. Hence, by this logic, for an investor to stop regretting investments in equity markets, his probability of generating profits need to be at least twice as much the probability of generating losses. As shown in Exhibit 15 in Chapter 2, replicated again below, the probability of a positive return from BSE index over the past 30 years, that is 1987 to 2017, has risen exponentially as we increase the holding period from 1 month to 10 years. Given Benartzi and Thaller's framework to understand at what point investors lose their regret about investing in equities, we simply need to look for where in the chart below is the probability of generating profits twice as much as the probability of generating losses. This inflection point for BSE Sensex is the 1 year holding period, where the probability of generating gains was 68% and the probability of generating losses was 32%. Exhibit 56, the probability of generating positive returns increases from with the holding period for BSE Sensex. There are two ways to interpret this conclusion. Firstly, investors who do not have even a year of patience are likely to believe that more often than not people lose money in equity markets. And secondly, as Benartzi and Taylor suggest, myopia implies that the more frequently we evaluate our portfolios and hence the shorter our investment horizon is, the more likely we are to see losses and hence suffer from loss aversion. Inversely, the less frequently investors evaluate their portfolios, the more likely they are to see gains. Let us now understand how an increase in patience, that is holding period beyond a year, benefits investment returns disproportionately. How patience affects returns for holding periods longer than 1 year. Let us introduce a term called patience premium. This is the difference between annualized returns generated by a stock or an index over any holding period compared to the return generated by the same stock or index over a 1 year holding period. A positive value of patience premium implies that the longer the holding period of a stock, the higher is the return generated from it for an investor. For example, if holding stocks for 5 years gives you 10% annualized returns, whereas holding stock for 1 year gives you 7% returns, the patience premium is 3%, 10% minus 7%. Our analysis showed that in general there is a significant patience premium and that this premium grows as you increase the holding period from 3 years to 10 years. Exhibit 57. Median equity returns for the Sensex are the highest over the 10-year investment horizon. As the exhibit shows, over the past 26 years for the Sensex, the patience premium did not exist for the 3-year and 5-year investment horizons compared to the 1-year investment horizon. That is, investors were not incrementally rewarded for being patient for 5 years versus 1 year. So does this mean that as long as the Sensex investor's investment horizon is less than 5 years, there is no benefit in being patient? No, it does not. As the holding period increases from 1 year towards 3 years and 5 years, volatility and hence risk of returns from a Sensex investor reduces significantly as highlighted in the following points. First, the 1 year investment horizon has the widest range of equity returns from a peak of 256% delivered over April 1991 to April 1992 to a trough of minus 56% delivered from December 2007 to December 2008. The 1 year investment horizon can be an intense roller coaster ride. Number two, the range of equity returns narrows over the 3 year investment horizon from a peak of 62% CAGR delivered in January 1991 to January 1994 to a trough of minus 18% CAGR over April 2000 to April 2003. The range Number three, the range narrows considerably over the 5 year investment horizon. The early 90s saw some of the highest returns with a peak of 47% CAGR recorded in the period spanning October 2002 to October 2007 and a trough of minus 8% CAGR recorded over August 1997 to August 2002. Number three, the range of returns narrows further in the 7 year rolling period. The highest return of 29% CAGR was delivered over October 2002 to October 2009, and the lowest of minus 7% CAGR was recorded over September 1994 to September 2001. Number 5. The 10-year rolling period offers the tightest range of returns with least returns at minus 3% CAGR over April 1992 to April 2002. The peak return of 21% was earned in the period spanning from May 2003 to April 2013. The 10-year rolling period is also the period with the highest median return of 13.51%. The more volatile the return over time, the riskier it is. For instance, a government bond which delivers an 8% annualized return over the 10 years is less risky than a listed company's stock price which delivers 8% annualized returns over 10 years. This is because the government bond delivers more or less 8% return each year with very low volatility, whereas the company's stock delivers the same 8% CAGR in the volatile manner. What statisticians call standard deviation can measure this volatility and hence risk in an asset's portfolio. As shown in the exhibit below, over the past 26 years, for the Sensex, the degree of risk involved in a 1 year holding period has been 3 to 4 times higher than the risk involved in 5 year holding period and 6 times higher than the risk involved in a 10-year holding period. Exhibit 58. BSE Sensex 1 year investment horizon is the riskiest with risk levels being 6 times that of the 10-year horizon. So, what does all of this mean for an investor looking to optimize their returns from equity investing while reducing risk? The exhibit below puts all of the analysis as discussed in this chapter so far into one graphic. The best way to grow one's wealth is to be in the bottom right corner of the exhibit, high return with low risk. Conversely, the worst way to grow wealth is to be on the top left corner of the exhibit, that is low returns with high risk. The Sensex return over the past 26 years suggests that as the investment holding period increases, from 1 year to 10 years, the investor's position on the exhibit moves from top left to bottom right. Exhibit 59. The risk versus return trade off for the Sensex improves as the holding period rises. The size of the bubble denotes the holding period. The dotted bordered bubble relates to the 1 year holding period of the 10-year government bond. The plain shaded bubbles relate to the Sensex. Adding the quality premium to the patience premium, let us assume that the quality of a stock is defined as the quality of its return profile, healthy and sustainable, that is consistently good, being better than weak and unsustainable. In order to understand how improving the quality of stock portfolio affects its performance for various holding periods, we rerun the analysis highlighted above, whilst replacing Sensex returns with the 17 iterations of the coffee can portfolios of 2000 to 2016. We introduce a new term here, quality premium, which we define as the difference between the annualized returns generated by a stock or a portfolio and the benchmark index, say the Sensex, over a particular holding period. A positive value of this quality premium implies that increasing the quality of the stock portfolio generates better returns for the same investment horizon. So, for example, if Rakshit's portfolio generates a return of 17% over a 10-year period, while the Sensex generates 13% over the same 10-year period, the quality premium for Rakshit's portfolio is 4%, that is 17% minus 13%. Our research on the Sensex return over the past 26 years and the returns generated by the coffee can portfolios since 2000 have produced some very interesting conclusions which we summarized below. Observation number one, the shorter the holding period, the higher the quality premium. This observation is counterintuitive. Interestingly, it is strikingly similar to the comparison between batting averages of two cricket legends, Rahul Dravid and Virendra Sehwag, for various formats of the game. Dravid was a great defensive batsman with an effortful rather than effortless batting style which lacked flamboyance characteristics that sound perfect for the test match format, that is, the 5 day matches. Sehwag, on the other hand, was an aggressive batsman ready to flirt with the unimaginable risk and looking to hit almost every ball over the boundary. Characteristics that sound perfect for a 1 day international 50 over match and T20 international matches 20 over matches. While Dravid is perceived to be the accumulator of runs, Sehwag is perceived to be the prolific scorer of runs. However, the table below shows an interesting comparison. Not only does Dravid outperform Sehwag in every version of cricket, Dravid's outperformance, as measured by his batting average, is the widest in T20 and the narrowest in Test cricket. Exhibit 6.3, Rahul Dravid has a higher batting average than Virendra Sehwag in all formats of cricket. The late Peter Roebuck, one of the world's greatest cricket writers, wrote, Dravid has a simple game founded upon straight lines, reasoning that runs cannot be scored in the pavilion. He sets out to protect his wicket. Curiously, Curiously, this thought does not seem to occur to many batsmen, a point many a long suffering coach could confirm. Michael Lewis' celebrated book Moneyball: The Art of Winning an Unfair Game, which went on to become a movie starring Brad Pitt, highlights the Rahul Dravids of Major League Baseball in the US. When it comes to stock markets, intuition suggests that shorter investment horizons are akin to speculative investing, where investors do not need to focus too much on the quality of the company to generate good returns. Over longer investment horizons, one would intuitively imagine investors would need to rely on high quality companies for superior returns. However, the chart below shows that whilst the quality premium exists across all holding periods for the CCP, the quantum of quality premium is higher for shorter holding periods, that is 3 years and 5 years, as compared to longer holding periods, that is 7 years and 10 years. Hence, the extent of outperformance that an investor can generate by upgrading the quality of his or her portfolio is greater for shorter holding periods compared to longer holding periods. Exhibit 61: The Quality Premium Coffee Can Portfolio Median Returns minus Sensex Median Returns exists for all investment horizons. Why does this happen? Why do the coffee can portfolio outperform the Sensex so handsomely over the 3 year and 5 year horizons? Remember, over the shorter holding periods, the Sensex returns are more volatile, whilst over longer holding periods, the volatility in the Sensex returns reduces very sharply. The CCPs are full of companies that are the Rahul Dravids of the business world, rare, determined, and constantly seeking to improve the edge or the advantage they enjoy vis-a-vis their competitors. As a result, the CCPs are able to deliver healthy returns with low volatility even over 3 year and 5 year horizons. Basically, the inherent consistency in the performance of the CCP companies gives the CCPs an even bigger advantage over the Sensex over the 3 year and 5 year horizons. As with Raul Dravid and the CCP companies, when the going gets tough, the tough gets going. Observation number two: a high quality portfolio with a very long holding period delivers the highest returns with the lowest risk. The principle of risk return trade off says that potential return rises with an increase in risk. That is, low levels of uncertainty or risk are associated with low potential returns, whereas high levels of uncertainty or risk are associated with high potential returns. While this principle holds true as an investor chooses between equities as an asset class over, say, government bonds, it is not necessarily true when an investor is seeking to optimize performance within an asset class such as equities. To be specific, it is possible and desirable to increase the return from an equity portfolio while reducing the risk associated with such portfolio. The exhibit below compares the volatility of returns for each holding period of the CCP as measured by standard deviation and shows that the longer one holds the coffee can portfolio, the lower the volatility of returns. Exhibit 62: The volatility associated with coffee can portfolios reduces as the holding period lengthens. To appreciate the power of this, we have created another exhibit which shows how the risk return trade off changes with time. This time, in addition to showing the returns from Sensex and the 10-year government bond, we have also shown the returns from the coffee can portfolio on this chart. Exhibit 63: Coffee can portfolio having a better risk return trade off than the Sensex for all investment horizons. The size of the bubble denotes the holding period. The dotted bordered bubble relates to the 1 year holding period of the 10-year government bond. Non shaded bubbles relate to coffee can portfolios and the plain shaded bubbles relates to index or Sensex. The key message of this chart is that whilst both portfolios, the Sensex and the CCP, produce better returns alongside low volatility, if held longer, the CCP beats the Sensex by a wide margin when it comes to producing superior returns, with its volatility being even lower than that of Sensex. An investor who is able to combine patience with high quality portfolio construction thus pulls off the holy grail of investing, outstanding returns with low levels of volatility. That is the essence of coffee can portfolio. The three key takeaways from this chapter: number one, patience, premium, and equity investing. Given the behavioral concept of myopic loss aversion defined by Shlomo Benartzi and Richard Thaler, investors who do not have even a year of patience, that is, stock holding periods less than 1 year, are likely to believe that more often than not people lose money in equity markets. For stock holding periods greater than 1 year, the Sensex return over the past 26 years suggests that as investment holding period increases from 1 year to 10 years, the investor's position on a risk reward matrix moves from high risk low return to low risk high return. Quality premium in equity investing is higher for shorter time periods. Let us assume that the quality of a stock is defined as the quality of a return portfolio, healthy and sustainable, being better than weak and unsustainable. Intuition suggests that shorter investment horizons are akin to speculative investing, where investors do not need to focus too much on the quality of the company to generate good returns. Over the longer investment horizons, one would intuitively imagine investors would need to rely on high quality companies for superior returns. However, our analysis show that while the quality of premium exists across all holding periods for coffee can portfolio, the quantum of the quality premium is higher for shorter holding periods, that is 3 years and 5 years, as compared to longer holding periods, that is 7 years and 10 years. Hence, the extent of outperformance that an investor can generate by upgrading the quality of his or her portfolio is greater for shorter holding periods as compared to the longer holding periods. Number three, combining quality premium with patience premium. Whilst both the Sensex and Coffee Can portfolio produce better returns alongside lower volatility if held longer, the CCP beats the Sensex by a wide margin when it comes to producing superior returns, with volatility being even lower than that of Sensex. An investor who is able to combine patience with high quality portfolio construction thus pulls off the holy grail of investing, that is, outstanding returns with low levels of volatility.